Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the third quarter, bonds again lost money and stocks headed deeper into a bear market. Inflation remains elevated at 8%. The Federal Reserve, the biggest factor this quarter, continues to crank up short-term interest rates at a fast and furious clip. Who doesn't know midterm elections are here? Let the political games begin. Russia's war on Ukraine still casts impact on energy and food. For the year to date, U.S. large companies fell even more to negative 24%. U.S. small company stocks inched lower to negative 25%. Overseas stocks did a deep dive to negative 27%. Bonds aren't helping at all this time, but have lost an unprecedented negative 15%. Large U.S. companies are expected to increase earnings by 3% this quarter, that's year over year, after growing 12% in the first quarter and 10% in the second. The year overall is expected to grow 7%, but some pros expect it to come in at only 3%. Businesses are doing okay so far. Some supply chain issues remain. Some inventories are building, think Target and Walmart. Labor shortages are easing, while some companies in some sectors have even started laying off workers. Unemployment fell to 3.5%, and jobs are still being created at a healthy pace. Inflation on both wages, that's 5%, and what we buy, that's 8%, is still high. GDP growth reflects a recession if it's defined as two negative quarters. First quarter again dropped down 1.6%. Second quarter was down 0.6%. The third quarter is predicted to grow a positive 2.9%, slower than last year, but as we expected. Why has the stock market been rallying and then swan diving? Pros are trying to guess when inflation has peaked, how long inflation will remain elevated, and when inflation will finally start dropping. And they're not guessing well or in concert. Inflation drives what the Fed does, which is what pros really want to predict. Some pros expect a shorter, softer recession. Some pros predict earnings to slow far more and the markets to reprice far lower before this is all done. When the Federal Reserve raises rates, the economy feels it. Mortgage rates are close to 7% now, double at the year's start. Housing is slowing. Money market rates are close to 3%, even though savings bank rates still seem stuck below 1%. The Federal Reserve started 2022 with short-term rates at 0.25%. They've raised that rate to 3.25%. Another 0.75% up to 4% is expected in November. Don't forget that the Fed just doubled down on its monthly balance sheet reduction as well. It's now removing $95 billion of stimulus each month. The Fed has stated repeatedly they intend to keep at it until inflation corrects back down and stays there. What is happening internationally? Energy prices are high. OPEC just agreed to cut oil production, so it's likely prices will adjust upward. Europe is suffering from overall inflation of 10% compared to our 8%. Overseas central banks are raising interest rates to combat that inflation, which will slow business. China and Japan continue with slow economic growth, low 3% inflation. Those two are keeping rates low to stimulate growth. Their economies haven't soared as ours has. Bottom line, it now appears that this is not over quickly. If Schwab's research is accurate, that bear markets accompanied by recessions extend over a year, then we are likely in that trough now, frankly. The market usually looks 9 to 12 months out, so corporate guidance during upcoming earnings seasons is key. When do pros see the end of high inflation and the end of Fed rate hikes? Here's some good news. Bonds should start working for us rather than against us. But stocks will still pose problems until the pros can see beyond this slowdown ahead. I am grateful to work for clients who've ridden through bear markets before and managed cash flow well. We've kept our portfolios diversified over different asset classes. Those different investments move up and down at varying levels and mitigate the harsh losses in some stocks. As long-term investors, we know earnings may move down now, but eventually we will enjoy economic growth again. Thank you for your interest. Please call or email if you want to dig in further. I am glad to pass on articles I've read and the other sources.